Hello, it's Finance Talk. Today we will speak about diversification and why it is important in the portfolio. Stay tuned. While managing a portfolio, it is important to consider such things as different risks. The risk is the probability of a particular event to occur. So, in order not to lose all the money and start from zero, the thing like diversification is very important. In classic theory, there are different types of diversification. First, between different industries and sectors. In this case, we can say that they correlate with each other. So, when one sector or industry goes down, the other goes up. For example, I can buy stocks of online and offline retailers in the same industry. During the pandemic, there was a huge rise in online retailing, while sales of offline retailers declined. Speaking about different industries, traveling and commercial logistics is also a good example. During the pandemic, one industry declined significantly, while others raised to new levels due to headwinds of e-commerce trends. The next type is buying securities of different jurisdictions, like stocks of United States, China, Brazil, etc. In this case, the portfolio is saved from different political and economical situations. The latest example of this is situation in Ukraine. Then some companies were affected by that. If my portfolio has a geography diversification, it can be saved from such situations, and while European stocks decline in price, the other markets will rise. Also, there can be a diversification in currencies. I can buy European stocks and convert my US dollars into euros, or buy local Chinese companies for yuan. In this case, if the currency is strong to my main portfolio currency, US dollars, I will also receive gain due to currency rates and vice versa. There also can be another type of diversification which most top value investors use. It is called the margin of safety. Here's the example of how it works. Suppose you would like to build a bridge which will hold the weight of 10 tons. In this case, the engineer will build the bridge which will hold 20-ton weight and then in the end put the sign of 10 tons. So in this case, if there is a risk of overweight, it will not affect the bridge and everyone will be safe. How does it work in the investing world? It's simple. I buy the stock which has more value than its price. For example, I know that the company earns 100 million in net profit for 2021 and has 100 million stocks. So the net earnings per share is $1. The company PE is 10, which means that I need 10 years to get back my money. The stock price in this case is $10. But if it drops to $1, this means that I have a PE ratio of 1 for the stock and I can get back my money in 1 year, which is equal to 100% annual return, which is pretty good. But in order to do that, you need to know business well, you need to understand the investing principles and finance basics. That's why I created this channel to teach myself and other people of how to better evaluate companies. Another advanced technique is not to buy a lot of companies, but in this case, all these companies have different streams of income inside their businesses. For example, Amazon have a lot of side projects besides its main stream of income. There are marketplace, Amazon Web Services, logistics, offline stores, and other projects in different spheres which are quite diversified. In this case, the diversification rule works inside the company, not outside in my investment portfolio. Now let's talk about how to understand whether the business is diversified or not. There are several factors on which I look at. First, if the company has a lot of different projects. This can be seen by looking in annual report in revenue section. Usually there is some information about streams of income year to year and quarter to quarter. I can also look for different news about the company in press release sections or just in Google News. If you do not know how to do it properly, here is my another video explaining this. If the company spends more money on research and development, there can also be a sign for that. Second, the company has many acquisitions like technologies, startups or other companies. They can be in the field which company operates or a different one. Third, the company operates in different countries and has revenue streams in different currencies. For example, Mattel or Apple sell their products in United States, Europe, Canada, etc. Fourth, the company has joint ventures with other firms or government. This can be strategic partnerships or other projects to get more market share in one or several fields or bring more value to the market. Now let's talk about another question. What should be the proportion of assets in a portfolio? Well, there is no correct answer for that. There are several opinions. balance. One group of people think that the investor should broadly diversify his or her portfolio by different asset classes like stocks, bonds, real estate, etc. The percentage can depend on different factors like the degree of risk the person would like to take, the level of income, family situation, age, and others. Then, the person can rebalance his or her portfolio in a particular period to maintain the proportion. Some professional companies like Vanguard or just personal financial advisors can calculate the exact proportion for you. I'm not a professional financial advisor. All the content based on my experience and knowledge, and the final decision should be made by you. The other group of people think that the person should buy a limited amount of stocks, but those in which he or she is confident. This means that the investor understands the company which he buys, knows their strategy, competitive advantages, and can project future earnings of these particular companies. The example for that is Warren Buffett, who carefully chooses companies for his investments and has a limited number of stocks in his portfolio. There is one negative aspect of such diversification. If stocks are not chosen properly during the market correction, such portfolio can lose more money than average one. Which type of diversification is better for you? And do you know more tips about that? Please write in the comments below so we can discuss them. And as always, please subscribe to the channel to know more about new great videos. Thanks for watching. Bye.